Hey, what's going on everyone? Thanks for checking out this video. My name is Travis from Master the Market, and this is going to be a quick video talking about some tips to help you grow your trading account in 2021. So tip number one is going to actually be to look into the past and review what happened in the year 2020. So you want to look back and see what strategies worked well, what strategies maybe weren't the best way to trade or invest in the market. And on top of that, you even want to look into your past trading data to see what you did well and to, of course, see what you can improve on in 2021. So for example, if we look at the chart at the bottom of the screen, this is the ETF for the S&P 500, which is SPY. And as you can see, there was a pretty big sell-off here in late February and in early March, and that was, of course, due to the worldwide COVID-19 pandemic and all of the economy and government shutdowns. So we ended up seeing SPY fall about 35% from its high up here down to its low of $218.26. And the one strategy that worked really well in the stock market in the past year was to simply buy the dip. Now in this case, it was a little bit more than a dip because we did have a pretty big sell-off in the market. But by buying into that dip and buying into that sell-off, anywhere down here or even anywhere along the way as it started to rebound, it would have been a very profitable way to get into the stock market as the S&P 500 ended up making new all-time highs by the end of the year. Okay, so with that being said, this is probably going to continue to be a great strategy heading into 2021 because historically the S&P 500 does return about 10 to 11% on average per year. So buying in the dips along the way is a great way to get your feet in the water and start investing into the stock market. Now with that being said, most of the people that are watching this video most likely are more interested in shorter term trading, such as day trading or swing trading, rather than these longer term investments into the general market. So to take things a step further, when it comes to looking into your past trading data, one of the ways that I like to keep track of that information is to have some kind of spreadsheet of the trading data, such as the one that I have here in this example. So you can see that in this example, I'm keeping track of the date, the number of shares, the average entry cost, the average exit cost, whether it was a profit or loss, the percent return, the profit return, and the loss return, as well as the type of trade that it was. And here in the profit or loss section, you can see that I'm using a 1 for a profit and a 0 for a loss. So that way, when you highlight the entire column, down here at the bottom, it's going to give you an average out of 1. 1 would, of course, be 100% accuracy, and 0 would be 0% accuracy. So in this case, just for these examples, it happened to be about 55% accuracy. So about 55% of the investments or trades ended up being profitable. Now also you can see over here under type, we have 1 and we have 2. 1 is the buy the breakout strategy and 2 is going to be the dip buy strategy. And keeping track of this type of information is a really great way to see what type of trades you do well with and what type of trades that maybe you struggle with. And once you've collected enough of this data, you can start to cut out the strategies that cause you more losses than they do profits and focus more on the ones that historically you've done the best with in the past. Now, another very important thing to keep track of is the percentage of your profits, as well as the percentages of your losses. So if we highlight the entire profit column here, you can see that the average profitable trade was a return of about 5.9%. And doing the same over here with the losses, you can see that the average losing trade was about a loss of 10.8%. So clearly that is significantly larger than the average profit. So if this was your personal trading data and your personal trading information, you could take this and realize that you need to start working on cutting your losses a little bit sooner and maybe work on also letting your winners run a little bit further to really start to make the most out of every single one of your profitable trades. Okay, and that's going to lead me to tip number 2 to grow your trading account in 2021, and that's going to be to find your niche in the market. This is something that is often overlooked when people get into the market and start learning to day trade or swing trade. Many new traders will try to, buy breakouts, they'll try to buy dips, they'll try to short sell into resistance, they'll try to trade options and different call and put strategies. And at the end of the day, all you're doing is spreading yourself a little bit too thin, and you're going to be much better off by narrowing down your strategies to only a few that work really well for you and starting to focus solely on those few strategies. So my recommendation to do this is to first start paper trading or practice trading with some kind of paper trading software. For example, the Thinkorswim platform actually has built-in paper trading. So if you're familiar with Thinkorswim and you have an account with them, all you have to do is open up the platform, and before logging in with your same login credentials, all you have to do is click this over here to Paper Money, and it's going to give you $100,000 of virtual practice money that you can actually use to practice trading stocks with absolutely no risk because it's not real money. Now, once you've done that for a while and you've collected some data from your paper trading, like we just talked about a moment ago, you can use that data to start to narrow down the strategies that work the best for you. And again, you can cut out the ones that historically have caused you more losses than they did profits. So that way, once you start trading in your live account with real money on the line, you're going to be focusing just on the strategies that are going to give you the best chance of being profitable on that trade. Now, tip number 3 is going to be to try to kick your bad habits in trading and try to, of course, take on good ones. Obviously, this is something that is a little bit easier said than done, but it is a very important step for long-term profitability in the stock market, so you might as well start to practice this now. I actually have a full blog post going over some bad trader habits as well as some good trader habits, and if you're interested in reading the full blog post, that's going to be linked down below in the description. But just to give you a quick preview, one thing, for example, that many failing traders do is show up to the market completely unprepared. That means that they're showing up maybe 5, 10, 15 minutes before the stock market opens without scanning and without looking up different stocks and different information, without looking at any news or press releases, without going through different SEC filings. And this is definitely a bad habit that you want to avoid, and you want to show up to the market very prepared every single day with a list of potential stocks that you want to trade, as well as a plan for trading every single one of those stocks. Now, on the other hand, a habit of successful traders is to simply study, and this can be as simple as watching a YouTube video like the one that you're watching right now, reading blog posts or books about trading and investing in the market. It can even be looking into past trades and past charts and patterns, so that way you can use all of that information to better prepare yourself to take on the market in the future. And the next tip to help you grow your trading account is going to be patient. First and foremost, be patient with your entries. And a good way to be patient with your entries is to simply have a plan, and not only have a plan, but also stick to it. So for example, if we look at the chart at the bottom, this is the stock Mara, and we're looking at the 1-day, 1-minute chart. So this is a short-term time frame that you would most likely be looking at if you were trying to day trade this stock. And because we can see that there is a little bit of resistance up here at about $15 per share, being that it's the high of pre-market, one way that you may look to trade this stock would be to buy the breakout over $15 per share, or wait for it to pull back and form some support down below. However, it's very common for inexperienced traders to see that at the market's open, it starts to trend up and move up towards that resistance. So they start to think to themselves, why would I wait to buy over $15 when I can buy down here at $14.40 or $14.60 and then already be profitable by the time it's breaking out over that $15 resistance? That, of course, is going to cause a loss when the stock does reverse down. However, if they would have just stuck to their plan of only buying this if it broke out over that resistance or pulled back and formed some support, they would have been able to completely avoid that loss. And that's exactly why being patient with your entries is a very crucial part of trading. So in addition to being patient with your entries, it's also important to be patient with your exits as well. And keep in mind that this is very different from being greedy. An example of somebody being greedy is if they were holding a winning position and the chart and all of the price action was signaling that now is the time to sell and lock in your profits on that trade, but they continue to hold because they want to make a bigger profit and they completely ignore all of the signals that the market is giving them. On the other hand, letting your winners run, if they look something along the lines of what we see here with this chart, is a great way to be patient with your winners and to really maximize the potential of every single winning trade. So what I mean by this example on this chart is, let's say that, for example, we bought in at about $12 per share because we saw that there was some trendline support forming and the stock was making both higher highs and higher lows. So even though the stock very quickly ran up to about $14 per share, sure, it would have been a good idea to lock in some of your profits in that run, but because this is still holding on to that same trendline support and it's still making higher highs and higher lows, as long as it continues to fall within your initial trade plan, there's nothing wrong with holding on to that winner and really trying to maximize the potential return on that trade. Okay, and last but not least, you also have to be very patient with your overall growth in the market. You have to remember that consistent profitability is not something that's going to happen overnight. It's not only going to take time, but it's also going to take practice and losses and lessons in order for you to become a consistently profitable trader. So be patient with the growth of your trading account. Okay, so I hope you liked those tips and found them helpful. If you enjoyed, please make sure to give this video a like and subscribe to the channel so you don't miss out on future videos. Also, if you're interested in taking your day trading, swing trading, and even long-term investing education a step further, all of that can be found on my website, Master the Market, which will be the first link down below in the description. But anyway, thanks again for watching. I hope you enjoyed, and good luck with your trading.